All right, we're going to be speaking with Jonathan Stern. He's chairman of the Natural Gas Research Program at Oxford Institute for Energy Studies. Mr. Stern, you just spoke about on the regional natural gas markets and convergence, and y'all had a lot of discussion on the differences in those markets. But in your view, is there ever a chance that these markets will form a global natural gas market?
I think it'll be a long time before we'll see a global market in the sense that we have a global oil market. So there will continue to be differences in price between the regions. But I think that the huge gap that we currently see will narrow somewhat between the regions. Not to the point where the theory would tell you it will be just the transportation distance between the regions, but it will narrow at least a little bit from where it is today.
And what would cause that narrowing exactly?
Well, essentially that narrowing will be caused by price arbitrage. In other words, as soon as US LNG exports get going, what we will see is companies buying that gas, usually on a spot basis, but even on a term basis it will be significantly cheaper if things stay as they are than the term contracts they currently have. So what we will begin to see is buyers saying we'd rather buy this gas and we'd rather not buy some of the other more expensive gas. That's going to cause some contractual problems, but I see these prices beginning to come together.
Do you think that's one reason the Japanese and Asian buyers are interested in doing the tolling agreements in the U.S.? Whether they ever use them or not, they can use this as leverage?
I think there's leverage, but I think there's also price optionality. In other words, for 30 years they haven't heard anything coming out of a seller's mouth other than crude oil related pricing. Now they're being offered something else. At the moment, with the current price dynamics, it's a cheaper price. Whether it will be a cheaper price later this decade is arguable, but it looks like it probably will be. And so it gives them something other than the crude oil pricing they have today.
So optionality is the important thing.
I think it really is the important thing.
And one last question. They talked about in the panel discussion. They did talk about having some kind of a pan-Russian, system with pipeline gas going into China and into Europe, which would draw the Chinese and European prices closer. Having some kind of arbitrage between those, getting those two markets closer. Do you see that as something that could develop?
No, this is what the Russians would really have liked. They wanted to arbitrage between China and Europe on price. But both Europeans and particularly Chinese were extremely resistant to this. And that's why any gas that goes to China from Russia will go from eastern Russia. It won't go from western Siberia, which is where the Europeans get their gas from. So you will see a continued distancing between supplies to Asia from Russia and the supplies to Europe from Russia.
Okay. They'd rather get the stranded eastern Russian gas, eastern Siberian gas. That's what they're targeting.
Well, that's right. That's what the Chinese are saying is, look, we don't want West Siberian gas. We get gas from Central Asia already from there. We want gas that comes straight into our eastern provinces. And that's essentially eastern Siberia and Far East, particularly Sakhalin gas.